Problem 23A at the end of your chapter gives us an illustration of the information that we need to analyze when we're trying to decide whether to discontinue or drop an unprofitable segment. So we have the financial information for Safety Step for the year ended May 31st, 2016. So if you'll notice, we see their income statement in a financial format. Sales less cost of goods sold to calculate gross profit, less selling and administrative expenses to come to operating income. And we can tell that from this financial statement analysis, Industrial Systems is generating a loss, a $39,000 operating loss. And so the company has decided to do an analysis to determine whether we should drop this line. Once again, an inexperienced manager would say, well, sure, they're not generating a profit. We can't continue to run this business. But we have two different product lines, industrial and household. So if we do a complete analysis, once again, what information is relevant to this particular decision? Because if we do drop this product line in the short term, what are we going to do in the long term? Are we going to pick up another product? What are we going to do with the additional capacity that we now have? And so in the short term, we notice they're not making a profit. Do we discontinue them? Do we look for ways to make them more efficient, a way to make our product more unique? What are our options? We need data to make this decision. So we have found out from our analysis that if we do drop the industrial systems, we could decrease the fixed cost of goods sold. Some of those costs were variable, some were fixed. So this we could decrease the $240,000 in fixed cost by $84,000. And we could decrease these fixed selling and administrative expenses by $11,000. So if we prepare a differential analysis, first of all, just to show what changes in revenue, what changes in cost, to show what would my change in operating income be if I got rid of this particular segment. And we see that here. Well, obviously, if I discontinue the industrial segment, then I'm going to have a decrease in revenue. So first of all, we need to take that into consideration. I'm going to lose $340,000 in revenue. Okay, and then I should lose all of my variable costs. Remember, this is the labor, the overhead, the materials that are used to manufacture these industrial systems. And so if we go back and look at our cost of goods sold, $35,000 were variable, and our selling and administrative expenses, $63,000, were variable. So if I get rid of this product, I can eliminate the manufacturing costs that are variable, and I can eliminate the selling and administrative costs that are variable. So I can eliminate $98,000 in variable cost. But your text said you can also get rid of $84,000 and $11,000 in your fixed cost. All right, so in this case, where fixed costs typically do not change, there are some fixed costs here that are directly traceable to the industrial systems. They would go away if the system goes away, to the tune of $95,000. So if this is the case, then I am eliminating $340,000 in revenue, but I am only eliminating $193,000 in cost. So if I eliminate this product line, I am going to eliminate $147,000 worth, or decrease my operating income by $147,000. This would not be a wise move. And so this is our differential analysis. What changes? Revenue goes down, these expenses go down. This would be my anticipated decrease in operating income. Okay, so if we put this into a contribution margin approach, as requirement 2 has asked us to do, we can see a little better what is taking place here. So if we look at our contribution margin statement, okay, remember this is sales less variable cost to get to contribution margin. So instead of looking at gross profit and net income, we're looking at contribution margin and income. And this allows us to separate all of our variable expenses from all of our fixed costs. If we do this, Notice we still have our unprofitable industrial system, but they are generating a $242,000 contribution margin. So they are covering their variable cost. They simply cannot cover fixed cost. And if you'll notice, between industrial and household, we don't really know, we don't have enough detail to know a whole lot about these products, but I can tell that the industrial systems is much more leveraged with property, plant, and equipment than household. Look at the fixed cost for manufacturing, $240,000 compared to $69. Selling and administrative also, 75% of what you would see increase from household systems. And so even though we're generating contribution margin, it's simply not enough to cover these manufacturing expenses. But I do cover my variable, and I do cover some of those manufacturing costs. So if we calculate the contribution margin income statement showing the showing safety step with only the household systems, this is what we would see. Hey, remember, household systems had sales of $370. They had variable cost of $46 and $75,000 respectively. So you'll notice our sales less our variable manufacturing costs, less our variable selling and administrative costs, will bring us down to contribution margin. So we have contribution margin for household. This is exactly the same as it would be if industrial existed or didn't exist. But what does change, okay, with our manufacturing cost, if we go up to the top, household had $69,000 in fixed cost of goods sold and $25,000 in fixed selling and administrative expenses. Okay, those costs remain. They do not change because household is still here. But what does change is the $240,000 in fixed cost for industrial can be decreased by $84,000, and the $41,000 in fixed cost for industrial can be decreased by $11,000. So we have the remainder as unavoidable fixed costs that still have to be covered by household because industrial no longer exists. So the unavoidable manufacturing fixed costs that cannot be gotten rid of have to be covered by household because industrial is no longer there. So in this situation, we see, even though we're generating $249,000 in contribution margin, that is not enough margin to cover households' fixed cost and industrial systems unavoidable fixed cost. So we show a $31,000 operating loss for our safety step as a whole if we discontinue the industrial segment. And if we do a comparison between this contribution margin and our differential analysis said that our operating income would decrease by $147,000. Decrease in revenue, decrease in cost. Revenues are decreasing much more rapidly than cost if we discontinue this segment. So if I have a $147,000 decrease in income, operating income, we started out with operating income of $116,000. I'm decreasing it by $147,000, which ends up with a $31,000 loss. I tell you that to show you that we can either use the contribution margin approach to analyze whether I should discontinue this segment. We get a $31,000 loss, or I can use the differential to show you that operating income is going to decrease by $147,000. They both generate the same facts because 116 minus 147 is 31. So I'm simply showing you two different methods that you can use to calculate the potential loss, either the actual new operating income or loss, $31,000, or the decrease from the 116 that we started with, the decrease of 31,000. I'm sorry, we started with 116,000. It is decreasing by 147,000, which leaves us with 31,000 of operating income. All right, so even though our segment is not profitable at this point, it would cost us more money, more loss, if we discontinue it at this point. So we need to go back and rethink our strategy and try to determine if there is something different or more efficient that we can do in managing these, especially these fixed costs that are so high for this particular division.